Ladies and gentlemen, we have seen US government bond yields and bond market volatility shoot up very, very significantly in recent weeks. And that has caused equity markets around the world, especially in emerging markets, to pull back very, very sharply. Here in India, the Nifty has corrected by almost 11% from its most recent high that was made on 26th of September 2024. We can also see early signs of Nifty finally making a bottom and also trying to rebound. Are there any indicators or market parameters that can potentially help us understand if the early signs of a rebound that we are witnessing in case of the Nifty can really sustain or not? Well, that's exactly what we are going to explore in this episode. Ladies and gentlemen, welcome to the third and final part of this series where we are trying to discuss what are the key drivers of the ongoing bout of volatility in the Nifty that we have been witnessing since early October 2024 onwards, and what are the implications for the Nifty in the light of the historic victory of Donald Trump in the recently concluded US presidential elections. Ladies and gentlemen, we have been witnessing a roller coaster of a ride in the Nifty ever since the Fed started its most recent rate cut cycle on 18th of September 2024, which is when the Fed kickstarted its most recent rate cut cycle with a big bang 50 basis point cut. And that was immediately cheered by equity markets around the world with very strong rallies. The Nifty here in India hit a new all-time high of almost 26,200 points by 26th of September 2024. But since then, there's been a dramatic reversal in the fortunes of the Nifty. The Nifty has corrected by almost 3,000 points. That's a correction of almost 11%. Such has been the ferocity of the pullback that we have seen in the Nifty so far that despite the thumping victory of Donald Trump in the recently concluded US presidential elections, something that led to very strong rallies in the US markets, there was no relief for the Nifty here in India. Thankfully, we are finally starting to see some early signs of the Nifty at least trying to stage a recovery. Since last week, we have seen the Nifty rebound by almost 1,000 points. And in the process, the Nifty has now recovered almost 1/3 of the total 3,000 point correction that the Nifty has suffered since 26th of September 2024. What exactly is at play here? And what are the key drivers of the current bout of volatility that we have been witnessing in the Nifty lately? Most importantly, is the rebound that we have started to witness in the Nifty since last week really sustainable? Well, that's exactly what we are going to discuss in this third and final part of this series. We saw in part 2 of this series that the most recent bout of volatility that we have seen in the Nifty since September of 2024 was primarily triggered as a huge spike in US government 10-year bond yields since September of 2024. What's been the scale of this spike in US government bond yields? Well, as of 16th of September 2024, US government 10-year bond yields were at 3.62%. This is 2 days before the Fed started its most recent rate cut cycle. By 4th of November 2024, that's 1 day before the US presidential election, US government 10-year bond yields had shot up to 4.31%. And we saw in part 2 of this series that whenever you get such a big spike in US government bond yields within a short period of time, that invariably leads to a big spike in what is called the MOVE Index. The MOVE Index is represented by the red line. The MOVE Index basically tracks the volatility in US government bond market. So as a result of the big spike that we got in US government 10-year bond yield since September of 2024, we got this humongous spike in the MOVE Index. Well, a reading of 100 or more on the MOVE Index is usually considered high. A reading of more than 120 is usually considered dangerously high. By early November 2024, the MOVE Index had got to a high of 136. And why does this matter? Well, it matters because as we saw in part 2 of this series, that the MOVE Index and the Nifty have historically had a near perfect inverse correlation. The red line is the MOVE Index, the blue line is the Nifty. As you can see, the two almost look like mirror images of each other. Whenever the MOVE Index goes up, the red line goes up, the Nifty, the blue line, goes down. And whenever the red line goes down, the Nifty usually witnesses very strong rallies. And this is probably offers the best explanation of why we have seen a nearly 11% correction in the Nifty, because during this time we have got this humongous spike in the MOVE Index. And that's why, ladies and gentlemen, I had reiterated in part 2 of this series that before the Nifty can start to stage a recovery, it's imperative that the MOVE Index must first start to come down. And guess what? That's exactly what seems to have happened since I published part 2 of this series. Since early November 2024, the MOVE Index has indeed started to come down. Since early November 2024, the MOVE Index has dropped from a high of 136 to under 100 now. Currently, the MOVE Index is at about 99. And just as the MOVE Index started to come down from its highs of 130 plus, we can see that the Nifty is also starting to stage a recovery. So how to make sense of this wild ride that we have seen in the MOVE Index and the resulting wild ride that we have seen in the Nifty? Is only if we are able to make some sense of this wild ride will we be able to make an informed guess about whether this drop in MOVE Index and the rebound that we have started to witness in the Nifty, are these two sustainable or not. Ladies and gentlemen, in my opinion, volatility that we have been witnessing with the MOVE Index and the Nifty lately is essentially an outcome of a conflict that is currently at play between what is happening with inflation in reality in the US and what bond investors expect to happen with inflation in the near future in the light of what the Fed is doing and the policies that Donald Trump is likely to implement once he assumes office on 28 January 2025. The reality about inflation in the US is that it continues to remain low. In fact, it is trending downwards. And this is very, very consistent with my long-held view that the US economy has been slowing down very, very drastically and is very likely headed into a recession in the near future. This is also the reality which finally forced the Fed to start cutting rates from September of 2024 in order to support an economy which was distinctly starting to show signs of a slowdown. But what is counterintuitive is that this reality is now starting to conflict with what bond investors are expecting to happen with inflation in the near future. We saw in part 2 of this series that just as the Fed kickstarted its most recent rate cut cycle with a big bang 50 basis point cut on 18th of September 2024, there were fears amongst bond investors that the Fed is possibly cutting interest rates by too much too soon at a time when the economy is still relatively strong. The economy has still not slipped into a recession. And there were fears that if the Fed continues on a trajectory of aggressive rate cuts, then it could end up tempting consumers and businesses to take advantage of lower interest rates and go on a spending spree, something that can potentially lead to a scenario where inflation could once again start to spike up. And that's why bond investors started to drive up US government 10-year bond yields in the aftermath of the Fed starting its rate cut cycle, because US government 10-year bond yields is, after all, the compensation that bond investors demand from the US government to offset the impact of inflation. And if they expect inflation to go up in future because of Fed's policies, then they are likely to demand a higher yield on US government 10-year bonds from the US government. And that's exactly what seems to have happened in the aftermath of the Fed kickstarting its rate cut cycle from 18 September 2024 onwards. And expectations of inflation starting to trend upwards in the near future got a very, very strong boost on 5th of November 2024 because of the historic victory of this man. Donald Trump's victory indeed introduces a whole bunch of unknown variables to the equation. In fact, for the first time in a very long time, I'm starting to fear that if Donald Trump indeed follows through on all the promises that he has made in the run-up to the elections, then there is a very real risk that inflation could indeed stage a comeback, at least over the medium to long term. Not in the immediate future, but there is a risk that inflation could stage a comeback over the medium to long term. And the reason for that are these two flagship policies that he has been advocating very, very strongly in the run-up to the elections. First is tariffs, second is tax cuts. Let's examine both of them one by one to understand why they are likely to be very, very inflationary over the medium to long term. Let's first take up tariffs. Donald Trump has indicated very, very clearly that he wants to increase tariffs on all kinds of imports into America from other countries. He, of course, wants to hit imports from China as hard as possible, but it's not as if that he is going to spare imports from other countries. He's basically going to impose tariffs on imports from every country. In fact, He has even suggested that he wants to replace income tax with tariffs. I want you to understand the implication of this if this is followed through and if he actually implements this. For context, the US federal government currently earns about $2 trillion annually from income taxes. He wants to replace this completely with tariffs. So he wants to earn $2 trillion from tariffs. Currently, the base of imports into United States from other countries stands at about $3 trillion annually. On this base of imports, if he has to generate tariff revenues worth $2 trillion, then he has to impose an average import duty of 67% on all imports. Can you imagine what is it going to do to inflation if he actually imposes average import duty of 67% on all imports into America? Inflation is absolutely going to go through the roof. I must reiterate at this stage that an outcome such as this should not be considered as foregone by any stretch. Because if Donald Trump's track record from his previous term is anything to go by, then he might be taking these extreme positions merely as part of negotiation tactics in order to probably get a favorable trade deal from China and other leading trading partners of the United States. And well, if he gets a deal that he considers as a fair deal for the United States, there may not be a need to impose such punitive tariffs after all. Now coming to his second flagship policy that is likely to be inflationary over the medium to long term, and that is his proposed tax cuts. In his first term, Donald Trump reduced corporate tax rates from 35% down to 21%. In his second term, Donald Trump has already promised that he wants to bring them down even further from 21% down to 15%. And he believes that by bringing down the tax burden on businesses, he will be able to stimulate the economy and he will be able to produce a higher rate of GDP growth for the US economy. Whether that really happens or not remains to be seen. But what is almost certainly going to happen is because of the lower rate of taxation, federal government's tax revenues are almost certainly going to fall. And that is going to lead to a situation where the US government's fiscal deficit is going to widen even further. And if US government's tax receipts go down as a result of a reduction in the effective rate of taxation, then bond investors fear that US government will have no other choice but to cover for this shortfall by borrowing even more from the bond market. And if US government's borrowings go up even further, then bond investors are likely to demand a still higher rate of interest, a still higher yield on US government bonds in order to lend money to the US government. And this is what has been contributing to the spike in US government 10-year bond yields since election of Donald Trump after the recently concluded US presidential elections. Ladies and gentlemen, it's not as if that this narrative of inflation likely to shoot up in the near future because of the Fed's actions and because of the policies likely to be implemented by the incoming Trump administration is going unchallenged. What we can also see is that this narrative is getting repeatedly countered, repeatedly challenged. Every time we get a release of monthly economic data related to the actual inflation situation in the US economy and monthly economic data related to the US jobs market. So for example, on 1st of November 2024, we had the US Bureau of Labor Statistics, the BLS, release the jobs report for the month of October. It showed that the US job market was in a very, very weak spot in the month of October. It showed that the US economy was able to produce only 12,000 new jobs in the month of October. Now, the jobs report for October was always going to be very, very weak, given that large parts of southern United States was devastated by Hurricane Milton, and there was a large industrial strike in Boeing, which impacted as many as 44,000 jobs. But despite these adverse factors, the consensus amongst Wall Street economists was that the US economy will be able to generate at least 100,000 new jobs in the month of October. Against expectations of 100,000 new jobs, in reality, the US economy was able to produce only 12,000 new jobs. This was one of the clearest signs that the US jobs market was slowing down at a very, very rapid pace. If you have a jobs market which is slowing down at such a rapid pace, consumers are no way going to have the kind of spending power that is required for driving up inflation. And that's why as soon as we had the release of the October jobs report, we had an immediate pullback in inflation expectations. And as a result, as I explained a little while back, the MOVE Index started to drop very, very rapidly. We had the MOVE Index drop from a high of 136 to its current level of under 100. And this happened in the immediate aftermath of the release of the October jobs report. Something very similar happened just today itself. On 27th of November 2024, as I'm recording this video, we have had the release of monthly data related to this very important inflation indicator called Personal Consumption Expenditure Price Index. That's quite a mouthful for the month of October. This is one of the most important indicators that is tracked by the Fed to gauge whether inflation is going up or going down. It shows that prices have gone up by a mere 2.3% year on year, which has been exactly in line with the consensus expectation of Wall Street economists. In fact, today's data confirmed that inflation continues to remain benign, and as a result, as soon as this data was released, we have had 10-year US government bond yields slide down by 5 basis points in a single day. Ladies and gentlemen, these are very early days, but the monthly data releases that we have got so far related to inflation and job market is increasingly pointing towards the possibility that in this business cycle as well, things could well pan out the same way as they did back in 2007. And this is something that I had explained in very many details in part 1 of this series. In part 1 of this series, I had explained that there is nothing unprecedented in inflation expectations starting to shoot up in the immediate aftermath of the Fed starting its rate cut cycle, especially when the Fed starts its rate cut cycle with a larger than expected 50 basis point cut. For example, as we saw in part 1 of this series, the last time when the Fed started its rate cut cycle with a 50 basis point cut, which was back in September of 2007, at that time as well, as soon as the Fed started to cut Fed funds rate, immediately there was a spike in inflation expectation amongst bond investors, and as a result, bond investors started to drive up bond yields. We had not one but 2 instances of bond yields shooting up. First time by 40 basis points, the second time by 50 basis points. But I had also explained in part 1 of this series that while bond investors can drive up bond yields temporarily out of fears that inflation can potentially stage a comeback, bond yields can continue to stay up only if subsequent data related to inflation confirms that inflation is indeed going up. But if subsequent data related to inflation fails to confirm that inflation is going up and instead starts to point towards the fact that inflation continues to remain benign and probably is trending downwards, then bond yields cannot continue to stay up. And ultimately, bond yields will start to trend downwards. And this is exactly what happened back in 2007 as well. After these 2 brief spikes in bond yields that was driven because of fears among bond investors that inflation can potentially stage a comeback, we ultimately, on both these occasions, the fears were proven to be unfounded and we had bond yields trending downwards. And then in January 2008, the US economy slipped into a recession, and post that, as we can see, there was a complete collapse in 10-year bond yields, especially towards the end of 2008, when it became very, very clear after the collapse of Lehman Brothers that the US economy is in a very weak spot and is very likely already in a recession. And what was the impact of this on equity markets? Well, we saw back in part 1 of this series that between September of 2007, which is when the Fed started to cut Fed funds rate, and January 2008, which is when the US economy slipped into a recession, we saw very high levels of volatility in the Nifty during this time because of repeated instances of bond yields shooting up. During this short 4-month period, we had the Nifty pulling back by more than 5%, not once, not twice, but as many as 3 times. The first one was a correction of 9%, the next one was a correction of 7%, and the third one was again a correction of 7%. And despite all these, the Nifty managed to rally by a staggering 38% within a span of just 4 months between September 2007 and January 2008. And this strong rally of 38% could play out because the overall trend of 10-year bond yields during this time between September 2007 and January 2008 was towards the downside. What we also saw is that falling bond yields are stimulative for equity markets only up to the point that the economy is growing. Once the economy actually slips into a recession, falling bond yields are no longer stimulative for stocks. And that's why after January 2008, when the US economy slipped into a recession, while bond yields continued to fall, the Nifty experienced a brutal correction of 60% between January and October of 2008. And boy, can you see parallels between what happened in the immediate aftermath of the Fed starting its rate cut cycle back in September of 2007 and what is happening in financial markets since the start of the most recent rate cut cycle in September of 2024? Well, I surely can. Just like 2007, as soon as we got the start of rate cuts from September 2024 onwards, we can see that there's been rising inflation expectations amongst bond investors, and as a result, bond investors have been pushing up bond yields. And because of rising bond yields, the Nifty has been experiencing very, very high level of volatility. And again, this is something that was witnessed in 2007 as well. And the most important similarity between 2007 and 2024 is that we can see early signs of data related to inflation and jobs market emerging that can potentially counter and ultimately negate the narrative that inflation can potentially stage a comeback. We are not there yet. The notion of inflation being able to potentially stage a comeback is still the dominant one, and as a result, bond yields continue to remain elevated, and as a result, equity markets continue to remain under pressure. But with every passing month, the evidence is getting louder that the inflation situation continues to remain benign, and the job market continues to weaken, and as a result, there is very little chance that inflation will indeed be able to stage a comeback. But ladies and gentlemen, till such time that the debate between these two conflicting narratives related to inflation is conclusively settled. What are these two conflicting narratives? The first narrative is, of course, of inflation potentially being able to stage a comeback because of Fed's actions and expected policies of the incoming Trump administration. And the second narrative is that of inflation, in fact, trending downwards because of a slowing US economy and a slowing jobs market. Ultimately, as I explained, I personally believe that it's the latter narrative, that of inflation trending downwards. That's the one that's ultimately likely to prevail. But till such time that the conflict between these two narratives has not been conclusively settled, we have to remain open to the possibility that equity markets will continue to remain under pressure. In fact, we have to, I believe, remain open to the possibility that the correction that we have witnessed in the Nifty so far can get deeper still. And if you have to understand how deep a correction we can get this time round, I think it will be useful for us to go back to the period around late 2021, early 2022, which is the last time when we got a very significant jump in bond yields. Well, this was the time when the Fed started to hike Fed funds rate. And in response to the Fed starting to hike Fed funds rate, we witnessed a very significant jump in US government 10-year bond yields. As you can see here, between September of 2021 and June of 2022, US government 10-year bond yield shot up from 1.28% to 3.49%. That's a jump of 221 basis points. And because of this significant jump in bond yields, we also got a significant spike in the MOVE Index. During this time, as you can see, not only did the MOVE Index become very, very volatile, during this time, the overall trend of the MOVE Index was distinctly towards the upside. And what was the impact of this on equity markets? Well, as you can see, because of bond yields trending upwards, and the MOVE Index also trending upwards, we had the Nifty correcting by as much as 17% peak to bottom between October of 2021 and June of 2022. And this 17% correction that we got back in 21-22, I believe serves as a useful reference of the scale of the correction that we can potentially get this time round in 2024. I'm not saying that we'll necessarily get a 17% correction this time round. I'm merely saying that this can serve as a useful reference. In fact, I believe that the scale of the correction that we are likely to get this time round in 2024 is likely to be less than the scale of the correction that we got back in 21-22 because of two reasons. Firstly, the scale of the jump in bond yields that we have witnessed so far in 2024 has been significantly less than the scale of the jump in bond yields that was witnessed back in 21-22. Secondly, this 17% correction in 21-22 happened in the backdrop of Fed hiking Fed funds rate. Whereas the correction that we are witnessing right now in the Nifty is happening in the backdrop of Fed cutting Fed funds rates. So on both the counts, the correction that is happening right now is happening in a less adverse macroeconomic landscape compared to the correction that happened back in 21-22. And that's why I'll be very, very surprised if we get a correction of more than 15% peak to bottom this time round. That's not to say that a 15% correction from the most recent peak of the Nifty is going to be without pain. A 15% correction from the Nifty's most recent peak of 26,200 points would mean a Nifty at about 22,000 points. That's more than 2,000 points below where the Nifty is currently. But guess what? Instead of trying to speculate on the scale of the correction that we are likely to get this time round, at this stage, I'm trying to focus on something far more important. Are there any indicators that we can look for that will potentially signal to us an end of this correction as and when the end of this correction actually materializes? Well, an understanding of any such indicator for me is far more important at this stage than trying to speculate on the scale of the correction that we are likely to get this time round. And here again, the 17% correction we got back in 21-22 has important lessons for us. So what is it that brought about an end to the 17% correction back in June of 2022? Well, in my opinion, what brought about an end to the 17% correction was a regime change from what I call the red zone to what I call the amber zone. And what are the indicators that can potentially confirm the onset of the amber zone? Well, firstly, once the amber zone sets in, as you can see, the MOVE Index, while it continues to remain very, very volatile, the overall trend of the MOVE Index is no longer towards the upside as it was in the red zone. In the amber zone, the MOVE Index instead starts to trend sideways. Also, once the amber zone sets in, as you can see here, the MOVE Index first witnesses a drop. And accompanying this drop in the MOVE Index, we also get a drop in the bond yields. And because of a combination of drop in the MOVE Index as well as bond yields, we get a reversal in trend of the Nifty. The 17% correction in the Nifty comes to an end and we get a slow and steady grind up in the Nifty. This is still not a breakout in the Nifty, but at least the Nifty stops correcting and starts a slow and steady grind towards the upside. And what brings about this change in trend of the Nifty is a combination of the MOVE Index coming down and accompanying that bond yields also coming down. So these two things are the prerequisite for the onset of a amber zone. Now, if you contrast this to what is happening right now, you'll see that so far we have got a drop in the MOVE Index, but we have not got any material drop in bond yields. And in the absence of any material drop in bond yields, I am not completely sure if the ongoing bout of correction in the Nifty is really over or not. So the indicator that I'm looking for is that bond yields also should start trending downwards along with the MOVE Index. And as and when that happens, that will be the confirmation for me that this ongoing bout of correction in the Nifty is finally over. In fact, I strongly believe that once the current bout of volatility in the Nifty gets over, we'll get one last regime change from the amber zone to what I call the green zone. Last time we got a regime change from amber zone to green zone in March of 2023 when we got this big spike in the MOVE Index. And we got this big spike in the MOVE Index in March of 2023 because of this very high profile bankruptcy of this regional bank in California called the Silicon Valley Bank, the SVB. And because of the collapse of the Silicon Valley Bank, the Fed was forced to intervene and inject liquidity into the banking system. And just as the Fed started to intervene and inject liquidity into the banking system, we saw this very strong downtrend in the MOVE Index. And as the MOVE Index started to trend downwards, we got this very strong breakout in the Nifty. And I believe that before the current business cycle comes to an end because of the US economy eventually slipping into a recession, we will see the onset of this green zone in the current business cycle itself. And I believe that the onset of this green zone will eventually happen once we get a conclusive resolution of the debate between the two conflicting narratives related to inflation. In favor of the narrative that inflation is now decisively trending downwards in the light of an economy that is rapidly weakening and a job market that is distinctly slowing down. And once we get the resolution of this debate, I believe that we will get the onset of the green zone, which will be marked by a strong downtrend in bond yields, and that in turn will propel the Nifty upwards for a very strong rally towards that final blow of top that we are likely to get before the onset of a recession in the US. But for now, my focus is not the green zone. My focus is on looking for the onset of the amber zone. And I believe that the onset of the amber zone will be marked by a downtrend in MOVE Index, and in conjunction with that, it is also likely to be marked by a downtrend in bond yields. And as and when we get a simultaneous downtrend in both MOVE Index and the bond yield, I believe that will in turn mark the onset of the amber zone, and that in turn will signal the end of the ongoing bout of volatility in the Nifty. And that is what I am trying to focus on for now. Ladies and gentlemen, on my part, once I get a confirmation of the onset of the amber zone, which will automatically mean an end to the current bout of volatility in the Nifty, I'll of course keep all of you updated from my side. But what will probably give me the greatest amount of satisfaction is if you, my dear audience, are able to use the thesis that I shared during the course of this three-part series to look for indications for the onset of the amber zone. Ladies and gentlemen, this brings me towards the end of this episode and also towards the end of this three-part series. But before I end this episode and this three-part series, I want to touch upon this request that I have been repeatedly getting at the end of each and every one of my videos, which is that I should consider producing each and every one of my videos in Hindi as well. Ladies and gentlemen, I fully appreciate the fact that if I am able to produce my content in Hindi, then a lot many more people will be able to follow my content. But at the same time, I also want you to know that producing these videos ends up consuming a humongous amount of time and effort. And to produce these videos in two languages, Hindi and English, will end up consuming that much more time and effort. At this stage, I am struggling to even keep up with a weekly frequency of posting my videos. And this is when I am posting videos only in one language, English. God knows what is going to happen if I try to produce my videos in two languages, English and Hindi. But given how relentlessly many of you have been pursuing me to produce my content in Hindi as well, I'm now giving a very, very serious thought to this. So this is what I'm planning to do. I'm going to post this video on my LinkedIn and on my Twitter profile. And if you want me to produce this video in Hindi as well, then I'll request you to head to my LinkedIn or Twitter profile. So this is my Twitter profile and this is my Twitter handle. My Twitter handle is @Indranil Guha. Please note that there is a double A in my name, @INDRAANILGUHA. That's my Twitter handle. And this is my LinkedIn profile. You can go to my LinkedIn profile through the URL linkedin.com/IN/Indranil Guha. Once again, here there is a double A in my name, INDRAANILGUHA. You can go to either of these two profiles, either to my LinkedIn profile or to my Twitter profile, and there I would request you to reshare my most recent post, and in the process of resharing my post, I would request you to let me know in case you want me to produce the video in Hindi as well. And if I see a sufficient number of people expressing their interest to see my content in Hindi as well, then I'll definitely give it a shot at producing at least my most viewed videos in Hindi as well. Ladies and gentlemen, this brings me to the end of this video and to the end of this 3-part series. I sincerely hope that you liked the insights that I shared during the course of this 3-part series. If you did, then please do like and share this video. And one final request, please do consider subscribing to my channel. This is something that is not going to cost you anything, but would be immensely helpful in increasing the reach of my content. Thank you very much.